This is definitely a topic that I know we've been asking all of our interviewees, people we've been reporting on about, and I know lots of people are eager to know what is in store for VC in Europe in 2024. Obviously, funding has remained down across the board. In this year's Atomico State of European Tech report, looks like funding is going to be on track for 45 billion this year, which is down more than half from the peak in 2021. So it'll be really interesting to dig in with our amazing panelists to figure out what's in store for next year. I'm very happy to be joined today by Ertan Can from Multiple Capital, Gloria Bauerlein with Puzzle Ventures, and Dan Chaplin with Dawn Capital, who all have great insight into what's happening in European VC from all kind of different vantage points, I think. So we'll be able to dig in both to what VCs are seeing and then also Ertan from you as kind of the LP perspective on what's happening on the ground. If you have questions throughout the talk today, you can put them into the Q&A section at the bottom of your Zoom screen. I'll be keeping an eye on those throughout the conversation, and then we'll be picking up on questions at the end of the thing. So just feel free to put those in whenever something sparks your fancy and you want to ask about it later. So let's get into our conversation today, everyone. First, wanted to ask, set the stage, take us back a little bit. Everyone's been talking this year about how this is different, where we are now in European tech and European VC is different from 2021 when we were really at the peak of tech. Are things really so doom and gloom right now? And what has changed for European VC? Gloria, I see you on my screen. Let's come to you first.
Hey, thanks a lot for the invitation. So for me, at least in early stage as a pre-seed and seed investor, the year is really basically split in two. The first half of the year was pretty much not doom and gloom, but everyone was like waiting to see what would happen, where valuations would pan out, how AI is gonna shape the way we should be investing going forward, where the money would be, etc. And so everyone was kind of a little bit in a wait and see state. And I personally only made 2 investments in the first half of the year. Towards the end of the year, I think part of the market has changed dramatically. I would say actually probably 5% of the market, or the 5% top companies, or the hottest companies, it might not always be the top companies, but the hottest companies, I feel like it feels like 2021 again. Some of those companies are within AI, but there's also companies outside of the AI. But for whatever reason, might be because it's a very experienced founding team, might be because it's a topic that VCs are passionate about, whatever. They can easily raise money again. I'm seeing 20 million, 30 million pre-seed rounds again. So it's basically back to 2021. Then there is kind of a healthy middle where really things are moving again. You can get your pre-seed seed round done. Valuations are healthy. Probably going to take 2 or 3 months to fundraise, but it's not completely crazy. And I think the market has come back and it's very, very healthy. And then there's still half of the market that's probably where it was at the beginning of the year. But I'm definitely seeing that there has been movement in the second half of the year where if you ask a lot of early stage VCs, they would probably tell you that October, November have been the 2 busiest months since probably beginning of 2022. And so let's see how that's gonna continue as we go into 2024.
What about like founder sentiment, Gloria? How do you feel like founders are feeling right now?
I think founders are a little bit confused, at least when I look at my portfolio and talking to my portfolio, because I think they are seeing very contradictory signs from the market, where some people still tell them doom and gloom, cut costs, don't scale too quickly, extend runway, etc. And then they see these or hear of through friends of these like crazy rounds that are getting done. And I think they really need this kind of perspective on where do you stand in the market? Like, where are you? Maybe you were more going towards Series A, which is definitely a lot harder than pre-seed and seed are right now. And really, it's very difficult right now to really understand quite where you're at. So what I see is a lot of uncertainty, I would say. So I see a lot of founders that come to me as well and asking for, should we go fundraise? Yes, no. And I'm not recommending to go out fully fundraise and talk to 30, 40, 50 different funds right now, unless you really need to. So I tell them right now, in this market, it's best to test the market with a couple of funds that you want to work with, catch up with them and see whether they want to preempt and how keen they are. And if they are keen, let yourself pre-preempt it and raise ahead of what you probably had in mind. But don't go out fundraise right now without doing these pre-calls with investors to see where their head's at, because it's very difficult to predict whether, if you're going out with all guns blazing, proper fundraising round prepared, whether you'll be able to successfully manage or not.
Yeah. Ayrton, what about you? How does it look different from 2021 from the perspective of a fund of funds? What's changed?
Yeah. So I think in the last 3 years, we saw like three, maybe more even, really very differentiating events happening compared to the last, or within the last decade. I think in 2020, the whole COVID crisis, which we saw already, also in 2021, was like, we saw empty streets, people disappeared somehow, and all the business really didn't happen. But in the end, it really didn't have a big effect on let's say on the fundraising for GPs, for emerging GPs or GPs in general. Then the second big, for Europe at least, big effect was the Ukraine war. So suddenly we had a war within the European borders, and people felt that it's not, at least in the first 2 months, 3 months, there was like a very, very, very cautious time for a lot of people who wanted to deploy money. So I'm speaking about LPs, who said, okay, we would rather prefer to invest in US dollar at the moment and outside of Europe, even European LPs. I'm not even talking about, US or non-European LPs coming to Europe. But that second event was more or less, I think, after 3 to 6 months, neutralized, and it was a non-event, really. At least from a fundraising perspective. I'm not saying that the war was not a non-event. But and then the third thing that I've seen in the last 3 years is the increase of the interest rates. And in my opinion, this had the biggest effect on the fundraising environment since I'm in the market in the last 10 years. So it seems like a minor, event compared to COVID and a war, but it has economically the biggest effect on the total ecosystem, raising capital from LPs who have an alternative now to put money into interest rate that is, for most or for many LPs, high enough for the kind of risk that they take. So why would they increase their allocations to venture or in general private equity, the asset class of private equity? So this is, I think, the biggest game changer in the last 12 months. The speed of interest rates increase, and still having very high interest rates in the market. I think, speaking to market participants, we think that those interest rates will decrease again, and maybe in a similar speed. So things will probably change. We don't know when, of course, but this is, in my opinion, what I've seen in the last 3 years, the biggest effect. And hopefully with decreasing interest rates will be also a positive effect for the venture ecosystem again.
What about kind of on the, GPs that are coming to market now? I feel like we at Sifted, despite, rise in interest rates, I still feel kind of overwhelmed by the amount of GPs who come to us and say, we're raising, fund 1 or fund 2. Like, how much kind of, are people getting in touch with you who are trying to fundraise?
So this is a huge phenomenon, to be honest. Like, when I compare that to 10 years ago, we looked at roughly 50 funds a year. So 50 funds, total Europe, a year. That's it. That was our deal flow, maybe 70 or something. Today, it's like 500 to 1,000. So, and when I say today, it hasn't changed really from the last 2 years. So, you would expect in 2021 was a very positive year, so a lot of new VCs coming into the market. Now, last year, this year, we have the feeling it's not slowing down. So the number of new VCs entering the market, so people who want to raise a VC fund, is extremely high. That does not mean that all of them will raise a fund, right? So many of those people will not raise a fund or will not raise the initial target that they have targeted in terms of fundraising, or it will take them longer, take longer for them to raise the fund. And I think it's just a natural process that many will, like founders who want to raise their first investment, right? So the first round, many of the founders who want to raise the first round will not raise, and therefore will not continue to create the company that they wanted to create. And I think it's a similar process for VC funds. I can't imagine that 500 to 1,000 new VC funds will raise money. It just doesn't add up. Even if if we would say one of the most consistent, stable investors in the European ecosystem as LPs are government LPs, public LPs, and I think all of them, or more or less all of them, continue to have the programs. Some of them even increase the programs, like Germany, for example, and still they wouldn't, it's impossible for them to cover 1,000 new funds. So the question is, we see a very high number, which is good, because for us it just means we have a broader deal flow. There are a lot of potential new funds that we could back. Naturally, not all of them will raise money in the end.
Yeah, totally. Dan, I'd love to come to you. What companies are you seeing do well in this environment? Gloria, you talked kind of about that top 5%, right? Where things seem almost like they're 2021 again. What maybe from a business model perspective or a sector perspective are you seeing do well right now? What kind of founders?
Look, so I think I'll just take it back a bit before I kind of get to that. So I think Ertan's right. We've seen a lot of different kinds of environments even in the last 3 years. But I think it's important to remember where the European ecosystem has come from, because it's been a real change in the depth and the potential opportunity and the evidence of being able to create outsized outcomes out of the European ecosystem over the last 10 years. And even when you look at where we are today versus 2018, 2019, I think there's a greater depth of talent, not just at the founder level, but really at the operating level, like the bench of people that founders have to call upon to help them grow their organizations and know what it takes to build a really good scale up in Europe than there has ever been before. I really do believe that. And even when you look at the data that comes out of Atomico's State of European Tech, where fundraising seems to be significantly down this year versus last year, if you actually look at it in the context of where we were in 2018, 19, 20, it's pretty much bang in line. We're not in a significantly different environment. What has changed, which I think Ertan referred to, is that capital is frankly more expensive. The cost of capital that businesses are taking on comes at valuations that aren't quite as toppy as they were in 2021 for very good reasons. Because ultimately you have to take venture risk at an earliest stage, and ultimately you're competing with risk-free rates you're getting on US Treasuries. And when US Treasuries are higher, you're not going to be able to kind of generate the same kind of valuations for an early stage kind of business. So the kinds of business we're therefore seeing that are really thriving in this environment are the ones that have got their hands around capital efficiency. Like, how do you grow a business efficiently, sustainably with defensible margins at scale? And the businesses that have found not just product market fit, but have actually found business model fit, so the ones that can show why they're able to grow an organization sustainably, why they're robust, why they're defensible, why they're creating opportunity for platform over time, those are the kinds of businesses that are doing really well. So, it's interesting, a couple of the businesses in our portfolio, Cover Genius is one in the insurance space, Bright is another in the account-to-account payment space. they're thriving in this environment because, oddly enough, in a time where capital was cheap, they actually grew their business from a position of relative capital efficiency. They didn't take on a huge amount of capital early on in the journey, and it forced them to build a muscle to understand how you actually grow a business and a revenue line that is sustainable and has high margins and with potential operating leverage in that business. And then now being able to kind of take that and thrive in this environment where many businesses, and I think Gloria referred to the confusion that many founders face. And I think that confusion stems from the fact that they're being told completely different things from their investors this year versus 2021, which is how they actually generate value in the business. And value is coming from very different places. It's no longer a question of how do I tackle a market as quickly and aggressively as possible. It's how do I tackle that market efficiently and sustainably and with significant capital efficiency along the way. So it's a reorientation of the market. But I think there is as much depth of opportunity and as much talent to go after that opportunity as there ever has been.
Gloria mentioned that, the last couple of months have been significantly busier. Things seem to have picked up again. Dan, do you kind of feel that in terms of the companies that are coming to you?
I mean, we've been investing through this cycle, right? So, we've done 4 new investments over the last 12 months. As I say, we continue to see a lot of opportunity. I certainly think there's a huge amount going on at the very early stage in Europe. We're Series A+ investors. There's been less at the Series B+, I would say. But I would say that stems down to the fact that many businesses raise capital, and a lot of capital, in the good times in 2021, when, as I said, when capital was cheap, you naturally would decide to take on more capital than perhaps you might otherwise have needed. And we're seeing that kind of play through the system now. So many people haven't had to go back to market in 2022 or even the first half of 2023. We're starting to see people now come back to the equity markets. They might have tapped up venture debt in the meantime. They might have taken some kind of internal note that wasn't announced, but we're starting to see people return to the equity markets. And I think that acceleration is only going to continue through 2024.
Gloria, do you want to expand on the question of which companies you think are doing well right now?
Yeah. It's kind of interesting. So I've been in the venture business for the last 8 years. And if you ever asked me 2 or 3 years ago which businesses I would not invest in, it would probably be the companies selling to old school enterprises. Vertical software was shied away from because a lot of them are selling into regulated markets, etc. And that, for me at least, has completely turned around in the last couple of months. Why is that? So when you look into who has been successful in 2021, or successful in terms of growing really fast, which everyone cared about at the time, it was the companies selling into other scale-ups or into other startups. It was the Notions of this world, the Airtables of this world, that basically were able to sell into other companies very, very quickly. And startups usually have a quicker decision-making cycle. And so these companies were doing really, really well, got more funding, grew even faster, etc. That has completely changed. And those companies are, on average, not doing well anymore, because scale-ups are now the ones that have the tightest budgets. And startups usually don't have enough budget to even buy software or to be a very scalable customer. And so I've seen these kind of horizontal productivity software for other startups. Those companies are really, really struggling at the moment. That has completely changed, or what has completely transformed is the way I think enterprises are looking into buying software. So in my thesis right now that I'm trying to confirm, but it's the initial conversation seem to confirm it, is that AI has become board level conversation. Every board, corporate board today is talking about how AI is going to disrupt their business model, B, going to help them add new revenue streams, or C, going to make the companies more efficient, save costs, etc. So everyone is now trying to use or see how AI can be used within their organizations. What they realized quite quickly is that, wait a minute, we can't really use AI in a lot of functions of the business because we do not have digital processes, we do not have the data, or even if we have the data is not clean. So we can't really implement AI. So we need to digitize first and implement software, I don't know, Snowflake and a proper data lake and basic stuff before we can actually use AI. And so what I definitely see right now is that enterprises are much more willing to at least talk to startups and figure out how they can help them solve a problem. The question is whether that is going to be sustainable long term, or whether that's just a flare or a flame which will burn out really, really quickly. I'm not sure yet. But what I definitely see much more with seed companies and pre-seed companies, that they are able to get in front of enterprises much more quickly, much more easily, and that enterprises are willing to do a POC with them and work with them, and that AI is also much more well suited to change the way vertical software works. Because vertical software is all about processes across different parts of the function in an enterprise, and they're really a deep understanding of the end customer is needed. But then when you do have that deep understanding, then you can really do a lot with AI, which I think is a lot harder with like a horizontal software where everyone has a different process. It's being used across 20 different industries, where I think it's a lot harder challenge to make AI work versus in vertical SaaS. And so I see that there's a lot more really real applications in vertical SaaS using AI than there is in horizontal SaaS. And horizontal SaaS, a lot of it feels more like very gimmicky, stuff like copy AI, where you can generate marketing copy, but it doesn't feel sticky yet. The use cases I have seen in vertical SaaS that are using AI are much more ingrained in the deep processes of an organization, and hence feel a lot more sticky and a lot more sustainable. So I'm much more excited now about vertical SaaS and selling into enterprises than I used to be in the past.
Super interesting. Ayrton, what about, the GPs that you think are gonna do well in this environment? You talked about 500 to 1,000 funds out there raising every year. So which are the ones who are actually gonna be able to A, close a fund, right? And then B, actually perform well?
So first of all, there's a big difference between pulling a funds and performing well. I think I tweeted about it, and so the thing is, like 10 managers who raise a fund are successful in raising a fund, but only one of them will be successful in performing well. So 100% of everyone who raises a fund is successful raising a fund, but only 10% top decile, will be performing really well. So it's a very big difference. I think it should be not misunderstood that raising a fund is just the first step of really investing and performing a good fund. So to your question, we try not to time markets, and explain shortly why. We don't believe that we know today who will be the best managers, right? So I think we tend to have this opinion to just improve the chances of having potentially better investors, and slightly, try to have slightly or a little bit more on the better side than on the worst side. So that keeps us being, in the better quartiles. But the real answer is we don't know. So we don't know, out of the 30 funds that we are going to do in the next 3 years, we don't know which ones will be the best ones. Each single of them has the chance to be an outlier, or has the chance to have outliers in their own portfolio. Which one those will be, we don't know, right? And we also don't know which areas those will be. So we are completely agnostic. We don't have an opinion. We could back any vertical or geography within Europe. And it's mainly dependent on the individual, on the GP who's selling us a story and thinks that a specific areas, might perform better than others. And this could be, for us in the next 10 years, the next big outlier in our portfolio could be something out of life science. Of course, it could be something out of blockchain crypto. It could be AI. We don't know. We've backed the first AI funds in 2017, 2018. So back then it was not a hot, not a sexy thing. But we still had the feeling, we have to put an allocation in that field, because we think it's just, mainly again, one of the best managers we saw sold us the story. So he said, Ertan, you have to, it just makes sense to allocate into AI, and so we did 5 years ago. And to answer again the question, it's very difficult to say now from an LP perspective which ones will be the best in the next 5 to 10 years, because it takes 5 to 10 years to have visibility for the funds that invest today. So it doesn't matter which of the funds that are currently investing out of our portfolio, we don't know the results until we see it, and the visibility, you typically see real visibility after 5 years in a seed fund that starts investing.
What GPs, maybe to go to the question of GPs that are funding now, which GPs do you see being more successful at fundraising right now?
So fundraising, again, we don't see the correlation between fundraising or success in fundraising and success in performing. So there is no correlation between them. You see, like, this year and last year, you see first-time funds that raised 300 million. So for us, it's a completely, we don't understand it. And we think that those first-time funds raised the 300 million first-time funds are great at fundraising and marketing the fund. But it's just, but by design, this fund will be underperforming. Those funds will be probably underperforming. And of course, there's always a probability that even a 300 million first-time fund could be performing well, but probability is just low. And so again, fundraising success, very different from performing success. But fundraising success, I think there are more and more, I would say, profiles, right, that are more successful in raising funds. And I think spinning out from a successful or from a larger brand is always a good sign. I think Puzzle is a very good example, where it just helps if you have worked for a larger brand before. And I just had a call yesterday with someone who worked not even within venture. So he was like in a very, very large private equity fund. And to be honest, he raised this fund. So we never expected him raising the fund, because like it's just unusual, because he's never invested in venture really. But the kind of environment or the names that you take with you when you raise a fund can help. And I think more and more individuals build a real brand around them. So that might be through activity, media activity, having strong social media profiles. That helps as well. And I don't know if we have time to speak about that as well, but I think there's a new group of LPs investing into emerging managers, which we call founders, tech founders, and GPs of larger funds. And so for them, I think if someone has a good brand within venture or within the venture ecosystem, it's an easier yes for them to deploy money. Whereas an institutional or a family office or this kind of investors are just probably not even looking at a lot at brands on social media, so don't even understand the specific brands. But if you're a GP, and you see emerging GPs, you understand relatively quickly the brand of someone who's raising. But again, raising a fund is not performing fund.
For sure. Would love to talk a little bit about the fundraising question, maybe for founders, right? Gloria and Dan, you both picked up on the fact that founders are getting they're a little bit confused now, getting some mixed signals from investors. But what do you think what proof points do you think founders are going to have to show going ahead? What are investors going to be looking to see if a founder is out raising in 2024? Dan, maybe let's come to you.
Sure. So I think the fundraising landscape has changed a bit in that, not in the sense of the dilution that founders seem to be taking on at any round, but more in the amount of capital that they are actually taking on at each round. And so, given that the amount of capital that you're going to be more constrained with going forward to the next kind of 2 to 3 years of your growth journey, I think investors are really conscious that you have a really good use of funds explanation. So how you're going to deploy that capital, how you're going to reach the next stage. I think that's the addition that's come into the fundraising process. I think the fundamentals of what investors are still looking for, or certainly what we're still looking for, hasn't changed a huge amount. We're basically looking for companies that have really large addressable market opportunities, some kind of unique IP, whether that's team or really differentiated technology. We want to see companies that have explicably defensible moats that they can build into their organization or product over time. We want to see the ability for them to develop strong unit economics. Obviously, earlier stage businesses will have a harder time having proven that than some scaled businesses where the onus is really on them to have shown that they've got there already. And then we want to see teams that still have that really relentless determination and a track record of strong execution, whether that's in the business they're currently operating or whether it was in a business that they might have operated in the past, which is always helpful when people have second-time founders, although it's absolutely not a requirement to us making an investment. I think on a founder perspective, for that execution piece, what we often really look for is founders who have the ability to hire really, really well around themselves. So bringing talent into the organization that they don't really deserve yet. So, you're at Series A and you've managed to hire some absolutely fantastic person who, frankly, you shouldn't have had until you were kind of at Series B, C stage, but they're so excited about joining the journey with you that they've decided to actually take that risk and jump on board. And I think that's a really strong validation of the team and the culture and the opportunity that you're building towards, and is a really good tick in the box for us. So I don't think, I think the bar to raising has got higher, that's for sure. You need to be further on in the journey for every stage, at least on the nomenclature side. A Series A company today was probably a seed stage, a Series B company a couple of years ago, and the amount of capital that you're taking on has changed, but otherwise the fundamentals are pretty much the same.
Yeah. Gloria, what about you? What do you see, founders are going to need to show investors next year? And Dan, I love how you kind of talked about that little insight around, founders being really good at hiring and how that is a kind of a great signal for you guys. Gloria, what are some of those signals too that you look for?
There are probably two things I care about even more than I used to be in the past. One is about the business and one is about the team. So the one thing about the team that I care about more is that the team ideally has worked together in the past. So what I have seen is that, especially in early stages, it's all about iterating quickly. It's all about running in a certain direction and being very clear about, hey, I'm running in that direction, but the more I might need to run in the other direction, and being very methodical about it. What I've seen, especially when things are not going well, when things are not always going up and to the right from the get-go, that there is a opportunity to have disagreement, I would say. And people who've not worked together in the past, I've seen just a lot of teams break up. When I also look at my Angel portfolio, when I look at companies I've talked to in the last couple of months, I have seen more founder breakups than I have seen in the past couple of years, which I think is mostly driven because of the environment. It's just harder. Things are changing much more quickly, especially in AI. OpenAI is always adding new features, and your company will go out of business tomorrow. And so it's become increasingly important for me to understand why the team has teamed up together, ideally that they have worked together in the past, that they know how they work with conflict. And I really double down on that. So for me personally, I either, when I do pre-seed, pre-revenue, pre-product, I only work with teams that have known each other for a long time and have worked together. And when they have not, I wait until they raise a seed round and they've worked together for a year or 9 months on this particular company. The second thing that I double down on, and that's much more important for me now than it used to be, is also that the product is very sticky. So I want a product that's basically being used by the company every single day. It's part of the day-to-day operations. They couldn't live without it. There's high engagement in the product from day one. It might take longer for them to implement because they have to create trust first, because it's really an operating system more or less for a particular part of the company, etc. But once you're in, it's really, really difficult to rip you out. And I really care about that, because I don't think the other businesses that are easy to adopt, some kind of sales enablement tool, some kind of marketing tool, etc., they're super easy to adopt. So you get a lot of growth early on. But I doubt that you will be able to build a standalone, sustainable business long term with very good CAC to LTV ratios, etc. And so as growth is no longer that important in the early stages, I'm happy to compromise on this kind of explosive growth at the beginning for making sure that it's a software that's going to be very, very sticky, that's going to run a core part of the organization, especially because there's so much uncertainty around the recessionary environment and whether the economy is going to get better or worse. I'd much rather invest in companies that are must-haves, that are nice-to-haves. And I feel like a lot was invested in 2020 and 2021, even stuff that I did, which were like nice-to-have businesses, and they were not necessarily must-have businesses. And so I really changed that massively. And by now I only invest in businesses that are really touching everyday workflows, everyday processes of organizations.
Totally. I thought it's so interesting what you said about founder breakups, because that's definitely something that I've heard a lot more from investors recently, having to deal with that and those sorts of challenges that come with just being under more stress. Dan, I'd love to kind of come back to you and have you pick up on that. Like, what challenges are you seeing? Are you seeing more of this kind of founder strife and having to work with founders on that? Or what kind of challenges do you think that your founders are facing most right now?
Sure. So we're slightly later at stage than I think Gloria's invested.
Hopefully they're not breaking up at like Series B, right?
By the time you got to sort of Series B, I hope that you've managed to find a good working relationship with your set of co-founders. But obviously that's, isn't always the case, and that can happen even in the good times. Like people just find that their roles shift over time, and people end up in different parts of the organization, and managing teams is one of the major jobs of being a founder, and it's also why you have a board structure in place, because it helps you to work through some of these conversations when they come to a head. So, but look, I think that's not the number one thing that we're seeing founders having strife over. Obviously, the realization that you need to run a business in a slightly different way in this new environment where capital is not necessarily more scarce, but certainly more expensive, means that you're going to have to make some really hard decisions around the shape of your organization and the number of people within it. And that's just an emotionally testing thing for a founder to have to go through. Like the first time they make cuts to an organization, it's really not it's a really difficult message to deliver to your teams when you've been on a very different trajectory and suddenly things change, and then you have to make hard decisions and deliver difficult messages. And then you have to keep the organization together culturally once you've gone through that change. That's the thing that we kind of have to help our founders with most. Like we can be a sounding board. We've taken people through that journey obviously before. We also have a portfolio, so there are many other founders within the portfolio who can act as for being a founder is often a very lonely position, because there's very few other people who kind of have your job and are in your position. So being in a portfolio of CEOs who look very similar to you gives you other people to talk to. So it's almost like a wider advisory board that you have access to. So we're doing a lot of that kind of connectivity within the portfolio at the moment, just to allow people to kind of share ideas and have I don't want to say like an agony aunt almost.
For sure. Before we get into questions, because we've got a couple come in, and if people do have questions, I'll come to them in a couple of minutes. So please do drop them in the question and answer box. I'd love to kind of talk about the exit environment for next year. Maybe Ertan, we can come to you again. You know, how do you see the GPs that you've invested in thinking about returning capital?
So returning capital in the last 2 years has slowed down, in my opinion. But at the same time, we had our biggest exit, one of the biggest exits in our total portfolio was in this year, 2 months ago, in Germany. So again, I think for us as an ultra diversified fund of fund, and it's a good proof point also for potential LPs in fund of funds, that if there is a high diversification and you invested again 5 to 10 years ago, even in an environment like this, you can have an exit that makes a big difference. And so this happened in our case this year. But in general, I think we see funds slowing down distributing capital at the moment. It's just a natural thing. You have less distributions, less exits. But again, having said this, even a single exit can, from a single fund, which will then have a high distribution, can change things within a year like that. In general, like my previous answer, we don't think we can time these kind of things. So some of the biggest exits, like OpenAI, has one of the most successful times this year and last year, right? So this year, I would say. So if you were invested very early in OpenAI, this is like could be a very successful investment in 2023. So we are preparing now investments. So we do investments now in GPs, so invest in the next 3 to 4 years, and the results of those will be seen in 5 to 10 years. Now, what will the market look like in 5 to 10 years? Probably different from now, but we don't know. So this is also the same answer to this year or last year. The general answer is yes, it's slowing down. Distributions are slowing down.
What about, so one theme that, I've covered a lot at SIFTD this year and kind of seen sophistication levels increase on in Europe are secondaries, right? And the use of secondaries to try and get some liquidity back to LPs in the short term. Have you seen that?
To be honest, not in our portfolio. So and like I'm trying to find more data sets around that, but so far I think again secondaries is a great topic to sell to LPs. The whole idea, the concept, hey, we are now buying in a distressed market good companies for lower prices. We are the smart buyers, and then you don't have to wait 10 years because they are all mature. So we're buying mature companies at low prices, and we will sell them in 3 years and distribute in 3 to 5 years to you a great return. I think, again, like I don't think that this will work in a scaled way, especially for venture, right? So I don't see that happening in venture, to be honest. All the let's say valuable companies in our portfolio, people stick to those companies. Okay, they don't want to sell, and all the rest, no one should buy. Right, so it's not, even if it's a secondary with a 50% discount, you should not buy the rest, right? So it's, and again, in our portfolio, we have like 1,200 companies now. I think 150 to 180 are relevant. The rest is not relevant. So yes, you could buy a lot of secondaries in our portfolio, but is it worth? Does it make sense? Is it really a good portfolio? No. So, that's the, I don't see, like, we haven't seen really secondaries happening in our portfolio of 45 funds now. Not a lot, at least not like significant secondaries, not fund secondaries, not significant secondaries in companies. Might be also related to that most of the funds are seed, and of course most of the portfolio is not mature, but I would say like 10% to 20% of the portfolio is mature. So had raised A, B, C rounds, and have high valuations, maybe overvalued in the last 2 years. So there could be potential secondaries in that game. I think secondaries is a great topic to raise capital from LPs, but the story that the in my opinion, unrealistic story that you buy low and sell high within a very short period and just benefit from a distressed market. I think it doesn't work as well. And I can imagine that a lot of secondary money was raised in the last 1-2 years with that storytelling. I can't imagine that this secondary funds, the sheer size of secondary funds raised will perform well, because I don't see secondaries really happening in good companies a lot, at least not in our portfolio.
We've got just 15 minutes left, so I'm going to jump to some of the questions. We had a really interesting one. This participant is asking, do you think the profile of founders VCs will fund in this new paradigm will change? Over the last boom cycle, it was noticeable how many founders without much previous founding or operating experience got funded. Are we going to see a shift to more mature and experienced founders? Dan or Gloria, do you want to pick up on this one, maybe?
I'm happy to go first. I mean, I would say that it's a helpful thing to have a lot of experience of the problem that you're trying to solve. And I say this as a fund that invests specifically into B2B, and with much of the portfolio also going after enterprise. It just turns out enterprises are really complex, and they have a lot of complexity that's not obvious from the outside in. And often, the average age of the founders in our portfolio are somewhere in their kind of early to mid 40s. And it's usually because they spent 10 to 15 years experiencing the problem that they then go and build a company to try and solve. And they understand the intricacies of that ecosystem. They may not have founded a company before, but they at least understand the market and the domain that they're going to go and really tackle. You know, we often hear from people, it's great to come with a fresh pair of eyes at a sector and try and tackle things in a new way. Sometimes, like, you have to be really, really, really exceptional to do that. And you have to be a very fast learner, and the organization around you also has to learn very, very quickly. So not that it can't be done. And certainly I think that young, ambitious founders will certainly continue to be a feature of this new market environment. But I don't think the distribution across our investments is necessarily going to change from what it has been already in the past.
Yeah, definitely. Gloria, what's your view?
Yeah, so historically, I would put Europe into 3 buckets. So the first wave of founders, it was the consumer founders, really. I mean, that's what was driving the vast majority of the large rounds up until probably 2019, 2020. And I think if you are building something in consumer and really, really changing the way something is consumed, either a service or a product is consumed, I think it's good to be at the forefront of that, to be close to your customers, consumer customers, and to just iterate quickly, to be naive to a certain extent as well. So I think the consumer founders, on average, they were quite young, right? When you look at Marcus at Bolt, for example, Will at Deliveroo, I think that really benefited the hustlers, I would say, above experience. And so when you now look back, there is no correlation between age and experience and outcome, but it's because of where we were at in the European ecosystem 5 or 10 years ago, which was mostly driven by consumer. I then think when we had the shift towards more B2B SaaS models about 5 years ago, and when it was all about selling into other startups or into other scale-ups, it mattered a little bit more, didn't matter as much, because you were ultimately selling into other startups, quick sales cycles, not like multi-stakeholder sales, you didn't really need to understand every single function super well or every single industry super well. So I think it benefited the experienced founders a little bit more, but it was somewhat in between. Now with the move that I described before, where I think enterprise sales is becoming actually more interesting because enterprises are becoming more interesting buyers and more open buyers. I think experience by the founders is getting increasingly important. So I definitely see a lot more experienced founders starting companies as well, because all of a sudden it's interesting, it's attractive for them to do that. It's also less attractive to stay at the companies that they were at before, because the valuations are not going up and to the right all the time, because they can't increase their teams every single quarter. And so now all of a sudden starting a new company has become really attractive. And then what I've seen some of the older founders reflect on is that they have this perspective of, look, I've never seen such a big shift in technology in the last 10 years. Probably the last shift was really when things were moving to mobile. And now with AI, there is this other massive shift. So I definitely seen, in particular, technical experience operators that are wanting to use this massive shift in technology to start something. And they have not really felt the urge to do that 2 or 3 or 4 years ago, because they weren't excited about crypto, or they weren't excited about everything that seemed to have really represented a shift. So I think just over the last couple of years, experience have become increasingly important. And the average age of the founders, I think in the last 8 years since I've been in venture, has probably increased by 5 or 6 years, for sure.
Super interesting. Another question we've got, someone's asking about, with interest rates coming down again next year, are we going to see more of these mega rounds, so 100 million plus again in 2024, or is that going to stay difficult? Dan, what's your view on the mega round question?
I'm typically really glass half full, but on interest rates, I think I'm probably slightly less optimistic. I think the overture seemed to be that we're going to be higher for longer. And, I think ultimately, therefore, we're likely to see fewer 100 million type rounds for companies, at least at earlier stage, or for businesses that have less proof points. I think, the fundraising journey for companies in deeper tech areas or infrastructure type propositions from venture funds with a 10-year life cycle, that's going to be a more challenging story for people to invest behind in the new market environment. Having said that, I think that we will see plenty of 100 million plus rounds before, because in companies that are late stage, performing well, strong unit economics, and continuing to invest for efficient growth, because those companies still exist. The opportunities for them to go after are still visibly there. And, when you actually look at the amount of money in the market, we're at all-time highs for dry powder in private equity. There is masses of money on the sidelines still waiting to back fantastic companies. So I do think we will see more $100 million plus rounds. The kinds of companies they'll go into are probably slightly different, and we probably won't get to the same number as we were in 2021, but they certainly will happen.
Another interesting question, something that we've actually written a little bit on this year, is a question about continuation funds. Ayrton, do you think we're going to see more continuation funds in 2024? And also kind of a related question, someone's asking, do you think we're going to see funds with longer, fund life cycles that are going to be more able to accommodate companies like deep tech companies?
So maybe the second question first. We see already like the average life cycle of a fund is like 13 to 16 years and not 10. The real life cycles. And I think more and more LPs and as well as GPs realize that the 10 plus 2 is very, very optimistic. And we talked about secondaries. I think secondaries for GPs in successful companies, when they have to sell because of their fund lifetime, this is the kind of secondaries that we think can happen in the next decade, so that a successful company can be sold in a later round, or parts of a successful company of a smaller investor can be sold in a later round to a larger investor, and by that, through that secondary distributed earlier to LPs within their lifetime to LPs, even with deep tech companies. So if you're a seed stage company, seed stage fund investing in a deep tech company, you don't have to wait 20 years, right? So if that deep tech company becomes successful, there are a lot of reasons to sell in a very late, very large round some of your shares to distribute to your LPs. That is the second question. And the continuation funds. So continuation funds are follow-on funds, right? So funds that invest in later rounds of the first fund. Yeah, we see that happening. We saw that also happening in the last 2-3 years a lot. I think it's easier to handle versus setting up SPVs each time you have a follow-on round. It's just much more effort, much more resource that you need setting up SPVs each time you wanna co-invest or follow on. So yes, continuation funds I think makes sense and will happen in the next years as well for small seed stage or for smaller early stage funds that don't have a lot of capital to continue. We personally don't think you need it, so it's like an opportunistic thing. We think that following in your winners is not as attractive as investing in the winners early on and keeping the fund small. So maybe.
Okay, one more question, because we've got just a couple minutes left. Someone was asking about how the fundraising environment has impacted the size and structure of employee equity. And if fundraising were to pick up, do you think that we'll see changes in employee equity? Me, Dan, Gloria, do you want to pick up on this one? Have you seen any?
I could start. I mean, so I think companies have had to, retaining really good talent is kind of the number one priority for any CEO. So you need to make sure that you have really good people who are in your organization and are properly incentivized. Obviously, the funding environment, the valuation environment that we were in 2021 is no longer reflective of where we are today. And we've already seen many companies changing effectively their internal valuations, which has been widely publicized in the media, in order to bring them down to more realistic levels at which employee equity can be reissued, and therefore properly incentivize people with a real upside from where they're brought into the business. So I think that is very much already happened. I don't think that we've seen significant shifts in the actual structure or the amount of equity that's being offered to employees as part of their organizations. I would just say that we are at least seeing at a regulatory level, governments around Europe getting more and more aware of the need to structure these things in the right way to build a growing and healthy ecosystem in their local markets. And I think we're trending in the right direction there.
Gloria.
I think individual equity, I've not seen massive changes. The one thing I've seen a couple of times now is that companies start with higher ESOP pools. So I've seen now a couple of the companies I invested in with 15% ESOP pool at pre-seed and seed. It's mostly driven by the fact that a lot of the more experienced teams, they hire very experienced employees early. So the way I think the early team is being built, like 10 years ago, it was you just throw people at the problem and you have very junior engineers that are just getting stuff done and are working 80 hours a week and are working really, really hard. And they typically get less equity. What I've seen, especially with the experienced founding teams that have led larger organizations before, they want to keep their teams lean early on and just work with 4, maybe 6 engineers until Series A. But then they want to hire very experienced people because they're also solving harder problems, like more enterprise problems with much more focus on security. And so you really need to have experience building big enterprise software, secure enterprise software. And so they are actually, it's much more common now to give a senior engineer 2% equity, 3% equity, even though they're not co-founders. And so I've definitely seen founders being willing to put aside a larger ESOP pool, but rather than giving a person with 3 years of experience more equity than before, they're just hiring much more senior early employees to get them on board earlier than they would have been doing that 10 years ago. So that's probably the only change I've seen in the equity environment or employee equity environment.
So we're right on time at 1 p.m., but I feel like, Gloria, kind of what you said picked up on what all of you have talked about today, which is, yeah, I feel like a lot of the narrative might be doom and gloom, but we've really seen this huge maturation in European tech in terms of the people who are building, the kind of businesses that are building, and then the investors, right, who are backing those amazing businesses. And I personally think that that's just going to continue in 2024. So there's definitely a lot to look forward to. Thank you to everyone who joined us, and thank you to our amazing panelists. We've got our next Sifted Talks up about how startup founders actually get stuff done. You can check that out on sifted.eu/talks. For more, we'll also put a link in the chat for that. And thank you everyone for joining us. Thanks again. This was really super interesting. Loved it.
Thank you. Bye.
See you. Bye.